direct attempts to create a smoother equity curve usually cause more harm than good. They create more problems than they solve. So essentially what people are doing is you're saying, give me more infrequent iceberg risk in order to get rid of frequent survivable nuisance risk.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Eric Crittenden, Chief Investment Officer at Standpoint Funds. Real pleasure to have you here chatting trading with us, mate. We appreciate it. Thank you.
Pleasure for me as well. Thanks for having me.
I guess a lot of our audience are the budding traders, future managers, beginner and advanced systematic guys. So we're particularly interested in, the raw nuts and bolts of building trading strategies, the kind of philosophy that you have around your portfolio, trend following in particular, obviously. I did listen to, Rich and I both listened to your chat with Meb Faber and Jason Buck a couple of months ago. We thought that was a really good chat, actually. I mean, we can't match Meb and Jason, but we can riff on some of that stuff as well, but we probably want to balance that out with some of the, the nitty gritty of your trading strategy philosophy and just building models and backtesting and that kind of thing in general, if we can too.
Sure, it's your podcast. Let's do it your way.
Excellent. All right. Well, look, I'll just kick off with asking for you to give us a little bit of a background, like what got you into the industry and excited about trading.
See, I'm going to try to truncate that story because I have a tendency to go off on a tangent there. I spent 9 years in college to get one bachelor's degree. And the reason is I kept changing my major. I started off in pre-med. I studied meteorology, geology, geography, economics, then finance. And then I wanted to switch to computer science, but I started getting gray hair and it was time to get out into the real world and earn a living. Investments was definitely more interesting to me than corporate finance. I took a lot of computer science and math. I'm a very introverted person, and I really like figuring out why things work and trying to see what other people miss. I like to invert things, deconstruct them, take them apart, and then put them back together. Just to take one part out and see what that affects. So maybe I should have been an engineer. I'm not sure. Mm-hmm. So my first job out of college was as a teacher. I taught intro to computer science, business math, Microsoft Access, and Excel. That's probably one of the hardest jobs I ever had because you have to teach disinterested students in topics that they're not that interested in. My second job was working for a pretty large family office in the state of Kansas in the United States of America, helping them manage their money. That was my first experience seeing the psychological biases, the cognitive challenges of managing money. Things like tracking error and relative performance envy, anchoring bias, endowment effect, all of those things. So I got to live those in real time. I got tired of the weather in Kansas. You're probably not familiar with it being in Australia, but in Kansas we have, you call them twisters over there. They're tornadoes in the United States. Freezing cold winters, scorching hot summers. It's windy all the time. There's not a lot to do. So I packed my bags, moved to sunny Arizona. I've been here since 2001. Initially, my first job in Arizona was working on a trade desk for a local hedge fund here in town. Learned a lot about the institutional side of the business. Prior to that, it had been on the buy side, just managing money. And then on the institutional side for a hedge fund and a broker-dealer. After that, with a partner, I started a fund of funds company called Blackstar Funds, where we allocated out to systematic managers in Europe. There was one in Australia, and a lot in the US. And then we handled the equity investing internally. Started a mutual fund company, or co-founded a mutual fund company after that. And then 5 years ago, I left that company, recruited certain people to start Standpoint Asset Management, and this will be my final job. So I will manage this fund that we have here at Standpoint for the next 25 years, and then call it quits.
Good luck. Let's get into the philosophy then, the trading philosophy. And I want to hand over to Rich because he's our trend following master. But I've heard you say that you've built this fund indeed to manage your own money into retirement. So, the philosophy is that wealth preservation, but also doing what you want to do more so than necessarily what other people would have you do. And, that's really interesting. So tell us a little bit about the philosophy of bringing that together.
Yeah. So when you get into the final couple innings of a career, if you're in a place where you can do what you want, something you're good at, something that the world needs, something you love, and something that people are willing to pay for, I hope everyone can get to that point in their life and give it a shot because it feels really good. For me, that was building the portfolio or the investment product that I wanted to see in the marketplace, something that I would be comfortable holding on to through any market environment going forward. It's not guaranteed to work, but it's the best that I think a person can do for a terribly uncertain future that has durability, and is built around realistic expectations. And as I looked around at all the different vehicles in the world, the closest thing I saw to what I envisioned in my mind were some of the big multi-strategy hedge funds, primarily over in Europe. And I didn't want to pay them 2 and 20 or 3 and 30 or whatever they're charging these days. So I thought, well, could I build it myself? I certainly have the background and the experience and the resources to do it. So over about a 9-month period of time, I sat down and decided to attempt to build it myself. That was a kind of a grueling process. And then at the end of it, I realized that there's a simple version of this that gets me 99% of what I want. And simply, it's just building a good, durable managed futures trend following program, and then mixing it with tax efficient, fee efficient, high capacity global equities, and then taking your cash balances and putting them into a laddered treasury bill portfolio. If you mix those three betas together, you get the relatively smooth up and to the right equity curve over the last 50 years that I'm looking for. So it's historically been able to navigate, all kinds of market environments, the stagflation of the 1970s, the inflationary growth of the 80s, the crash of 1987, the S&L crisis in the early 90s, long-term capital management, the telecom blow up in 2002, the global financial crisis in 2008. It's not to say that it makes money in all those environments, but I would have been able to sleep at night and maintain confidence and would have had acceptable performance through all of those market environments. And so that's what I'm looking for. And I just want that in a format that's got a reasonable fee and reasonable tax consequences. And I just didn't see it available to most people. It was rarely available in kind of the big multi-strat hedge fund. So I created it. And now we're going to find out if the marketplace agrees with me, if there's other people that want such a vehicle for themselves. So that's what Standpoint is. To some degree, it's an experiment. We're going to build what I think is the optimal portfolio, and we're going to invest our money into it, and then we're going to offer it to other people and see if they want to come along for the ride.
You've also mentioned, I guess, making a portfolio depression proof, or planning for those really phenomenally bad events and making sure that you survive through them. That's a big part of the thinking.
Yeah, I would say that's part of it. So all of my research goes back to Jan 1, 1970. I don't really trust the empirical data that's available in the marketplace for dates prior to 1970. I also question whether certain strategies that people are running today would have been viable, say in the 40s or the 50s. It's not to say that the economic data back then isn't valuable to understand regime shifts, paradigm shifts, and how certain sets of rules can invert and no longer work. So I do a lot of research going all the way back to before the Great Depression. But when it comes to empirical data and testing strategies, I choose 1970 as my start date.
Just before I hand over to Rich, just you mentioned fees there. I had a very quick look on the site. You mentioned the fees, the 2 and 20 paying to Europe. What are the fees for the Standpoint funds?
So our management fee is 1.24%. And then there's another couple basis points that are called acquired fund fees that we pay for our ETF exposure. And in the US, that gets stacked on top. So the net expense ratio is probably 1.26 or 1.27, depending upon how much ETF exposure we have on in a given year.
So literally no performance fees.
No, you can't do that. Well, I mean, there are ways to do it in a mutual fund, but they're pretty gray area, and we don't do any of that stuff.
Rich, do you want to kick off a couple of a bit of a deep dive into Eric's trend following world?
So, Eric, listening to your college days, I'd call you a diversified student, and that's probably followed you all your life. But look, it's very interesting. So I remember I was very attached to your longboard asset fund, which was the fund 5 years ago you were talking about before you came over into Standpoint.
Mm-hmm.
And so I know trend following is a big component of your philosophy, but when I look at what you're talking about with Standpoint today, we've got global equities. I'm assuming that's long short. Global equities.
The global equities is long only.
Long only.
Yeah, yep. and it's actually a buy and hold position.
Okay.
Now we do have the same index futures in the managed futures program. So, and we will go short those and or long those. So if you net everything against each other, you can see something that is approaching long short or kind of long flat. Okay. But the equities themselves are through the ETFs, that's long only.
Okay. And your laddered T-bill structure, that's long only?
Yes. The treasury bills are long
and then
only.
You've got your managed futures component. So of those three pillars, what sort of allocation would you have to each of those three areas?
So the way to think about that is that we want equal risk contribution from our managed future strategy on one hand, and then our buy and hold equity strategy on the other hand. So you could think of it as if we've got 10% annualized vol, about half of that is coming from the managed futures component, and about half is coming from the equities component. The T-bills are just a place to park cash. We have a lot of cash laying around because the managed futures component doesn't require a lot of money to get your full exposure. You just have to pledge, 5-10% margin for the futures contracts. The rest of it's just sitting in cash. So when T-bills are paying us, 5% or 5.5%, we stuff it into 3 to 12 month T-bills and just roll those as they expire. So, but to answer your question, it's about equal risk contribution from the equities and the managed futures program.
Okay. We just had Corey on the podcast from Newfoundland who's talking about his return stacked options. So when you mechanistically break down your allocation, effectively, you've got that structure. You've got the leverage component with your managed futures. You've got your global equity exposure long only, and you've got your T-bill exposure with basically the residual cash out of that sort of relationship of all of the three. Mm-hmm. So, Eric, you've done a lot of papers in the past, some great papers. Going back into the early days, you wrote a piece on the trend following capacity of equities, which was a great result there. Would you like to sort of expound on that a bit? And did what you find back in those days with that research, is it still applicable today?
It's been a while since I looked at that. So I believe I wrote that paper for the first time in maybe 2006 and then did an update, I think, in 2009. I'd be shocked if the findings were meaningfully different because that paper looked at, I think, 30 years of common stock returns. So, and then, look at what's happened over the past couple of years, the semiconductor stocks like NVIDIA and Taiwan Semiconductor and during COVID. Yeah, I think a strategy like that probably would have navigated pretty well. Mm-hmm. you might be wondering why I don't employ a strategy like that, why I would have buy and hold equities in my current fund and not, given that I spent so many years, a couple decades actually, on trend following on stocks. So it's not that it stopped working or that I gave up on it. It's that when you take managed futures and you want to blend it with anything in the world, remember, I'm trying to get that smooth equity curve through all market environments. And I'm a managed futures believer. I believe managed futures is the best diversifier in the world. It's very difficult for people to hold on to, and it'll stomp on your nerves. But it is the best diversifier, in my opinion, to risk assets. But what are you going to pair it with? Well, here's the thing. If you build a really good long-short equity or a tactical equity program, it's picking up on the same themes, the same pressures, and the same rotations that the future strategy is picking up on. So you end up tilting towards equity sectors that are more correlated with a managed futures program. That's not what you want. When you want a smooth ride, you need things that are doing different, taking different risks at different times, or different risks at the same time and making returns at different times. So what I found was that plain vanilla market cap weighted global equities was the best spouse or partner for a durable, simple managed futures program. They just work together really well. It's very uncommon that they're losing tons of money at the same time or making tons of money at the same time. So that hit my ego a little bit that I'm not going to be able to build a nice tactical or a long short equity program because I feel like I'm qualified to do that. But they all kind of have the same blind spot as the futures program. Not exactly, but it's close. They line up. They both kind of underperform at the same time and outperform at the same time. So in the end, I had to do what's right for our goal here, and that is to just give up and go with market cap weighted global equities. And there were a couple benefits too. Market cap weighted global equities are very tax efficient. They're very scalable. There's no capacity issues, and they're incredibly fee efficient as well. So if you adjust for all that, I looked at it and said, well, that's what we need to do to achieve our objective in this particular product.
Okay.
Can I just ask that? No, go on, Rich. You're right.
No, you go, man.
Well, I was just curious. Let's come back to where we are, but just curious about the trend following on equities. If we could just tangent for half a second. What were the strategies that you favoured or that your research, highlighted were effective if one was going to trend? Because I understand we'd be talking about individual tickers here. Is that what we're talking about? Individual name equity strategies?
Right. That's the paper that I wrote back in 2006 and updated in 2009 was testing whether standard trend following strategies would work on individual equities.
And so what kind of strategies did you deploy there, and how much did it impact if you, like a retail trader, could not trade equities at a very substantial amount of leverage, like you could with futures? How much did that sort of hinder the performance, I guess, and how did you go about putting together trend following strategies on these on equities, and was it long short?
It was it was long short in a sense. So we started off by building a long only program, and that was actually a huge undertaking to do the backtesting back then. So the problem with individual equities is that most of them that existed don't exist anymore today. Mm-hmm. Right. So one of the things I had to do was figure out a way to go back in time and collect all the price and volume and corporate action data on all the stocks that would have been in the indexes that no longer exist today. That was an expensive and time-consuming undertaking. Once I did that, I had to structure a database with unique identifiers because a lot of stocks use the same symbol that an old company, after it got delisted, the symbol gets reused. So you have to create a unique identifier. So that's where the computer science and the database stuff I studied came in valuable. Then you had to properly back adjust for dividends, spin-offs, divestitures, mergers. Like you had to untangle all these corporate actions. Otherwise, you would see stock that was actually merged into a different one, but they both weren't trading at the same time, but the data providers are giving you a back-adjusted time series. Untangling all that was quite an undertaking. Eventually, I figured out how to do all of that, but it was a couple years of research. And nobody was interested in it at the time. And I thought, man, am I wasting my time? Because no one has an interest in this. But it was fascinating because at the end of it all, when I got it such that it was right, I could run a back test and see the results. But then I could do the easy thing, which is just buy data right now as it's presented to me and run the back test on that, and you get completely different results, right? Because it suffers from survivorship bias and it doesn't adjust for corporate actions. So if you look at all the stocks from, I think we started this in 1989 and then stopped it in 2006, about 40% of the returns came from the dividend component, if I'm remembering correctly. So if you don't collect the dividends and properly back adjust the time series and then factor that into your calculation of the trend, you get completely erroneous results. So you had to do all this stuff correctly. And what I think I found was that trend following worked pretty well on common stocks, well enough to justify building a product around it, even one that was going to charge hedge fund fees. But you had to have a lot of money to deploy the strategy because there's so many stocks and you have to take every trade because you don't know where the big winners are going to come from. And you have to capture those big winners. So you have to capture the NVIDIAs and the Taiwan semiconductors and the super microcomputers because it's a small, tiny minority of stocks that really drive most of the stock market's returns in any given cycle. I would say it's probably 5% of the stocks are responsible for almost all of the market's returns. Certainly 10% of the highest performing stocks would certainly get you all of the market's returns. So you can't run the risk of missing them. So you can't just pick a small subset and run this kind of trend following strategy on it. I mean, you can, but now you run the risk of there's just simply no cards, in that hand you're being dealt. And then no strategy can overcome that, or no trend following strategy can.
I think you're bringing up a point here, Eric, why so many people trading trend in equity markets use these rotational strategies or cross-sectional strategies. They don't have the capital to get the necessary exposure to deal with what you're talking about here, and therefore they get a totally different flavored result from probably a different edge as well. So, yeah, very interesting.
And they can get a good result too if they pick if they're lucky enough to pick the right sector to focus on or the right sample. But you can get unlucky as well. And luck is not something you want to invite into the process.
So did you deploy leverage or did you assume leverage on those stocks to be able to trade such a wide audience, wide range?
Yeah, our goal was to target a certain level of risk. And in order to get to that level of risk, the risk is the variable you're solving for, or it's the one you're controlling. The degree to which you're using leverage or not using leverage is the dependent variable in the equation. So if I want 20% downside risk, meaning I want my max drawdown to be about 20%, in a low volatility environment with high breadth, I'm going to have to use leverage on my whole portfolio. I may need to go 2-to-1 in order to get that level of risk. However, if the market environment changes, let's say 1999, where it's a very narrow market environment and the volatility is extreme, well, then you would see a program like this holding something like a 40 or a 50% cash balance in order to get that 20% downside risk. So we ran that program just like you would run a professional commodity trading firm or a professional CTA, where we're targeting the risk, and whatever the leverage ends up being, that's the dependent variable. We're not targeting a certain level of leverage. We want a certain level of risk at all times.
Well, the reason why I ask is if we can consider the average retail trader with an Interactive Brokers account or the like, they can only really get a certain amount of leverage, call it 2 times leverage, and then that's it, right? They can't even go further than that. So
I wouldn't recommend that they do. The problem with stocks, unless you're always short and very diversified, is that, it's a escalator up and a broken elevator crash down. So, if you're more than 2-to-1 leveraged and you've got a concentrated portfolio on, at some point, you're going to get a really, really bad outcome. So I know some people that can go 4-to-1, but they're doing more market neutral type stuff with, sector balanced long short positions. And that's not what we're talking about here. Pure trend following, I don't think anyone needs more than 2-to-1 or should be going higher than that.
So you've got you scanned quite a wide range of stocks in available common stocks in the marketplace. You're looking for traditional trend following entries, breakouts, and channel breakouts, and that kind of thing. You'll take whatever's moving But as you said, like if the whole market starts to move or some stocks really start to outperform, you need to keep loading up. And so how did you solve for the capital efficiency problem of having to have capital on hand to just keep taking that extra trade?
Yeah, that's what always comes up in life. I always follow the same mechanism, and is I've got a target risk. Let's just say it's 20%. I don't want to lose more than 20%. So I can easily take that 20% and spread it out over all my current positions, right? You're telling me, though, another sector broke out and there's 20 more positions coming in. Well, I just update the number of positions I have on, and I still have my 20% risk budget. I divide it now by a larger denominator, and I get a different amount of risk or position size in each position. So then I need to go back through my portfolio and say, all right, well, these guys are too big now. So I've got basically three options. I can skip these new trades. Bad idea. I can load up on risk and just take more risk than I want. It's a bad idea. Or I can shave down some of the old positions, get them back in line. It's free up the risk that I can now take on the new positions. So you think of it as like a manufacturing process, where you've got, you want to process more. Well, you got to turn more machines on. If the demand's super low, then we turn some of the machines off and send some people home. And you just manage it algebraically through time.
Yeah, fair enough. All right, Rich, back to you.
All right, Eric, back to standpoint. So you refer to standpoint as all weather. Now, just to clarify that all weather's been around for a long time, and we've got Ray Dalio popularizing the concept all weather, but you'd argue that he's predominantly long GDP. However, how would you characterize all weather, and particular focusing on your way of looking at path dependency, sequencing risk, K-guard to max draw? How do you put all of that together and convince investors that this is the way to view all weather, as opposed to that they might have an alternate view of how to view all weather?
It's a really good sequence of questions. All weather, the phrase, I think, is intuitive to people. It's like, well, you do reasonably well regardless of market conditions, and that's what we're aiming for. We're not godlike, though. We can't do really well in all market conditions, and I could create a market environment that's gonna put us through some pain. But we're doing the best we can to be prepared for as a wide a spectrum of plausible market conditions. In other words, we're trying to prepare. We're learning from the past, taking that knowledge and trying to convert it into wisdom and do smart things all the time going forward. So my definition of all weather is something that gets a good outcome from that process. And what's a good outcome? A good outcome would be having a real rate of return that's reasonably consistent through time. It's not a lost decade and then annualized returns of 20 and then a lost decade. That's available. There's all kinds of asset classes that are boom and bust like that. Instead, it's not something that beats the stock market all the time. The stock market is one of those lumpy asset classes that looks great for 10 years and tragically bad for 10, and then right back to great, and then who knows what you get next. People don't need any more of that. It's freely available. You can buy commodities, you can buy small caps, you can buy, technology, whatever. I'm looking for something that has a relatively stable, real rate of return. And I keep saying real because it's important. There are stable products out there that are very stable, but their annualized return is generally lower than the inflation rate. So, or, right around risk-free or lower. That's not helpful, right? I don't find that to be helpful. I don't want to pay fees, and I don't want to pay taxes on nominal returns that are below the risk-free rate or below the rate of inflation. So the real return's got to be there. I like drawdown as a risk measure. I particularly like drawdown calculated on an end of day basis rather than end of month. It's got its drawbacks, it's highly path dependent. So I do look at volatility as well, but the drawdown or the potential drawdown that you have on a probability weighted basis is very important to me. So I want the relationship between your real rate of return divided by the absolute value of your drawdown estimate. I want that number to be greater than 0.5. And it's hard to do. Like if you were to buy all the databases out there that collect data on all the different hedge funds and SMAs and variable annuities and mutual funds, so on and so forth. And you pulled them all into a database and you calculated their MAR ratio and their Sharpe ratio from the beginning of the fund to the end of its life. And then you dollar weighted it. You would see that only the most elite managers have been able to maintain a Sharpe ratio over 0.65. It's very, very rare.
Not to blow smoke, Eric, but the standpoint's at 1, isn't it?
Yes, right now. Now, the underlying strategies aren't at 1. The future strategy is probably 0.45 and the equity strategy is probably 0.45. But that's the magic of combining them together. And then T-bills are 0, right? Because it's the excess return over risk-free. So we'll get to that. I'll answer the question. Do I think I can maintain a Sharpe ratio of 1? But I won't answer it now. If you look at all the different strategies that have ever existed, it's very rare to find a sustainable Sharpe ratio meaningfully higher than 0.65. A few firms have done it. They usually have some sort of a market making operation in addition to their other strategies, which I will never have. That's too difficult, and it requires resources that I will never have. Geographic location is important for that. But without that, everything else on the table, I think that targeting a long-term real rate of return to max drawdown relationship of about 0.65 is elite. And that's what we're trying to do. And by mixing managed futures with global equities and treasury bills is I've concluded is the best way that I can attempt to do that.
Yeah.
So
I've noticed a lot of fund managers that, they seek this smooth equity curve, but what effectively they're doing is diluting what I call a lifting power of the portfolio. So they're getting this magnificent smooth ascending line, but as you say, it's not necessarily exceeding in the inflation rate. So the real return or the real lifting power, that the real compound geometry, I feel that a lot of managers are sacrificing that with a degree of smoothness, which is quite easy to achieve through blending ensembles together. But the loss of lifting power is one of my biggest concerns in that, Sharpe obviously penalized beneficial volatility. So that wasn't a very good measure to use. Sortino didn't look at path dependency, so that wasn't a very good measure to use. Now we're into the path dependent metrics. KGAR to max draw, very good one. There are other ones as well. But everyone is convinced that the straight line equity curve is necessarily the best compound geometry. But I'd argue that there are different geometries to that if you are not sacrificing beneficial volatility. In other words, managed futures or trend following, you occasionally get the magnificent, what I call step ups in the equity curve. Now that doesn't compromise compounding, yet by methods such as volatility targeting and all of these things that managers are doing to deliberately smooth their equity curve to create the smooth ride, is potentially compromising that lifting power of the portfolio. I noticed that you don't mind swinging for the fences, and I just want you to comment on what I'm talking about as well. Your philosophy regarding beneficial volatility, does it assist the cause, that sort of thing?
Yeah. So I'm very sympathetic to your perspective on this, and the geometry of financial time series returns is an area I've spent many years studying. And it's probably beyond the scope of today's conversation about the differences between arithmetic and geometric returns and the linkage between them. But I think I'll share with you my philosophy that direct attempts to create a smoother equity curve usually cause more harm than good. They create more problems than they solve. So essentially what people are doing is you're saying, give me more infrequent iceberg risk in order to get rid of frequent survivable nuisance risk. And that's a terrible trade-off, right? So there's a different philosophy though, and that is go build something that's really durable and robust on a standalone basis, and then build something else that's durable and robust, and then something else, and then figure out which one of them work well together as a team. And if they work well together and that reduces volatility, that's healthy. But the futures program, your macro program, should be very durable and robust, and it should be allowed to do the things necessary to maximize what do you call it? The lifting level or the lifting power?
Lifting power. Yep.
Lifting power. Yeah. Inside. So, and that has to do with how long are you willing to hold your winners? How much are you willing to discriminate against markets that aren't moving? Those are your internal levers and internal rules. Is it allowed to go anywhere? Can you load up on cocoa if cocoa is really taking off? Or do you have all these filters that try to, get out early or reduce position size or volatility smoothing? So I'm very conscious of what you're talking about. I don't know if I could speak particularly articulately. Yeah, say that 5 times real fast about it. But I'm very aware of what you're talking about and the trade-offs of directly trying to just lower the perception, because volatility is not risk. It's just a symptom of risk, right? And trying to manage symptoms is kind of like going to one of the pharmaceutical companies and saying, I feel terrible. Well, we'll write you a bunch of prescriptions or you can go to a functional doctor and say, I feel terrible. And they say, all right, well, let's look at what you're eating, how you're sleeping, your posture, all these things. So there's just 2 different ways to try to limit your own volatility. And there's a healthy, accretive way, and then there's the unhealthy, dilutive way. And you have a deep skepticism for that second path, and I share that.
Yes, I often find that those that do approach the linear equity curve path, they build up what I'm referring to as warehoused risk. In other words, risk you don't necessarily see in the return series over the time series, because negative skew events might be very rare and infrequent. And often you find very considerable periods of time where they've got this stellar smooth rising equity curve, but what they're missing is what I'm referring to as the warehoused risk. And because you don't see risk, I agree with you totally. Volatility is not risk to me. Risk to me is total loss. The risk to me is the risk that isn't seen necessarily in a back test, but is there dependent on a particular regime that might never have been experienced in the past. And that's where I'm looking for a solution, an all-weather solution, and I think you're onto it with this solution with Standpoint, in that the way you're marrying this ensemble of strategies together is looking at a far more diverse series of regimes than we've necessarily seen in the past, because regimes, we might have only had 4 or 5 regimes over the last 30 years. But there is potential, 11 billion different regimes that are possible that haven't been experienced in our backtest. So I very much appreciate what you're talking about here. And I often think that investors need to pay heed to this. And interestingly, you've talked about Standpoint being the fund that you personally want to trade. You've got a lot of skin in the game in Standpoint, as they say, or most of your investment monies are tied up in Standpoint. How are you going at attracting AUM from those traditional investors who are very reticent to incorporate levels of managed futures into their traditional portfolios of maybe stocks and bonds? How are you going, bringing them over? And what do you do to get that attraction?
Well, you start with just always being honest with people and asking them what causes problems for them. Like, our job is to solve problems for people, not create new ones. So a lot of times they'll ask me, why didn't you launch a pure managed futures program? Because obviously it would have done well over the last 5 years based upon what we know about your program. And my answer is always the same. That doesn't actually help people, because the relationship that an advisor has with his or her clients is such that they're going to be under pressure to sell it when it's out of favor and to buy it when it's in favor. And they're always going to benchmark it to what they know, the S&P 500 or the Dow Jones Industrial Average. And the way that all the cognitive biases work is that if you underperform for a couple quarters, they feel like something's wrong and someone needs to take action and someone needs to be held accountable. You just can't do it. So I've designed all kinds of experiments and tests that I can run people through. I don't do it anymore because it makes them angry. But it's basically to demonstrate to them their own cognitive biases. And when I run these tests, they pick managed futures. They love it after the fact, right? Because it made the biggest difference and it really increased the durability of their portfolio, cut the drawdowns, increased the returns, and made everything greater. But if you go back in time and you force them to live the sequence week by week by week, they lose their minds. And they're like, no, I can't. You got to get that out of the portfolios. They can't survive the path traveled. So like any good sailor or astronaut will tell you that it's not enough to get it right or scuba diver. It's not enough to get it right in the end. You have to survive the path traveled. And that's an order of magnitude more intensive in order to prepare to do that. So, sorry, I forgot the question. Did I go off on a tangent?
Look, I just noticed when you're describing your fund, you're talking about global equities, you're talking about systematic macro, you're talking about. I've noticed that you haven't used the word trend following. And is that because as soon as you mention the word trend following, investors run away?
Yes. But also, if you mention managed futures, they run away. And then they look at it and they're like, I don't know, I kind of like this. Why do you keep saying managed futures? It's like, well, it's half managed futures and half global equities. But yes, I mean, you ask the question, how do we attract business? How do we get traction? And by not saying those phrases over and over, talking about all weather, talking about, realistic expectations, durability, delivering results, and just being honest with people, saying, this is what we do with our own money. We think it solves problem X and a little bit of problem Y and 20% of problem Z. If you're worried about those things, you should give us a look. And a lot of people say, yeah, I'll take a look. And then they look at it, they talk to us, and sometimes it's a good fit for their portfolio. And they say, yeah, this will fit into my alternatives bucket, or this will fit into my equities bucket. And they put it in there.
Excellent. Look, we had Tom on the show recently, and he, of course, is a very good friend of yours, and I think chairman of Standpoint or whatever. But interestingly, let's talk about the psychology, because I know as a student you spent a bit of time at studying psychology as well, and I noticed that you're eating very healthily these days, and you also go to sleep probably at about the same time duration as Tom Basso does. He said he only takes a few minutes to go to sleep. So talk about the psychology and how are you approaching that? Obviously, you're achieving that with Standpoint. It gives you a smooth ride to enjoy the ride or whatever. But talk about your thoughts about the importance of philosophy with this approach.
Well, the most important thing about philosophy is understanding what yours is and being consistent with it. In other words, building a lifestyle around the positive aspects of any philosophy that you have. So for me, that's about being prepared. I very much like to be prepared. I don't like being surprised. I'm willing to do the work with a big smile on my face. So I want to be prepared, and I want the people around me that I rely on to feel the same way, be reliable, and be happy about being reliable. I like being relied upon. I like people trusting me, and I like the crushing responsibility for things that I'm good at. You got to get proper alignment. I'm really good at certain things and I'm not good at other things. So I outsource those other things to trusted people. So live your philosophy, understand what it is, understand your blind, or try to understand your blind spots, and then adopt the most positive attributes of your philosophy and actually implement them. And then find people that you trust that are good at things that you're not good at and integrate them into your life and share the spoils with them. I wish everyone could do that because it feels really good. So, but my philosophy, realistic expectations. We talked about Sharpe ratios, Sortino ratios, MAR ratios. I've looked at all the empirical data. A Sharpe ratio of 3, everyone says they have it, but why doesn't it show up in any of the databases? It just doesn't, right? Or if it does, it's some tiny fund that's got, 100 million in capacity. And there are some people that have been able to do it for 3, 5, 7 years. And then it goes negative after that because they blow up when Lehman blows up or long-term capital or whatever. So having an honest or an accurate interpretation of reality, the empirical data, liberates you to have realistic expectations. So that's extremely important to me. Understanding things like postdictive error and survivorship bias limits you from creating systems that are too good to be true, right? So having realistic expectations and understanding the pitfalls of backtesting or simulations or research, the merger of those two things is very powerful and allows you to look at something that's realistic and accept it and be able to tell this one's durable and the other one will never survive anything that it hasn't seen before or any kind of a regime shift that's meaningfully different than what we've seen since 1970.
Okay, I love this, Eric. What's the art versus the science in working this stuff out? So you've talked about preparing rather than predicting. You've talked about being prepared, that you like to be prepared. None of us know the future. We are building an all-weather portfolio so that we can withstand these worst-case events that could occur. So what's the art versus the science in backtesting, optimizing, building models that are prepared for that future without predicting? What is there? Is there a large logical overlay or an artistic overlay, a discretionary overlay into how you bring this all together to account for these unknowns, or is it still quite quantitative? But yeah, what's the approach to backtesting and strategy development that is mindful of this? That backtesting over historic data doesn't actually give you the best view of the future.
So Rich touched on this one point that is probably the one that comes to mind, is that you don't know what your drawdown is going to be because you don't know what the sequence of events is going to be, and you don't know what kind of paradigm you're going to be or regime you're going into. So just because your backtest may have had a 20% max drawdown, I can go back in time and just move that data around a little bit and turn that 20% drawdown into a 60% drawdown without changing the descriptive statistics. So how do you manage that going forward? Well, that part's actually, Rich may have a better answer, and I'd love to hear it. That's more art than science. It's how durable is it? How concentrated can it be? How much leverage is it using? How sensitive is it to paradigm shifts? And I'll share with you one. I haven't told this story in a long time, but when I was building my futures program, that's one area where if you're being honest with yourself, you're like, look, I don't know. I've got this historical simulation. I've got all the futures markets in there. All the data's clean, and I've got a durable strategy. I've done the best I can, and it comes back and it says the max drawdown was 20%. But you know that if you just jam some stuff up a little bit differently and you put the crash of 87 here instead of there right after this, that 20% becomes 40.
Yeah.
So what can you do? Well, people try things like Monte Carlo simulations and bootstrapping and sample and replacement. Sure, that's going to create some other environments, but they're just tangential. They're born from the same stuff, right? But it's still helpful to do. You can do that. One thing I like to do in order to ferret out uncompensated sequence risk is to redenominate all those futures contracts into different currencies. Totally jam up. The trends are the same, descriptive stats are the same, but denominate everything in the South African rand and then do it in the
creating
Russian ruble.
A synthetic contract, essentially.
Yes. And so if you can navigate that, of course, things should get a little bit worse. Well, actually, not always. Sometimes they get a little bit better, but as long as it's not meaningfully different, you can try that. The other thing I've done is change the implied inflation rate. You can embed an inflation rate in there, or you can take it out, because a lot of times people don't realize that one of the themes they're picking up on is they're just the risk-free rate, that lift over time in the term structure of the futures contracts, because they have like a really long-term system or it's a spread system. And they don't realize that all they did was financially engineer a way to extract the risk-free rate out. And the risk-free rate has like an almost infinite Sharpe ratio. They think they're brilliant, but it's like, well, you're going to have to pay. So anyways, you can do all that, the bootstraps, but at the end of the day, there is an art to doing all that. After you've done it all, you got to sit down and ask yourself, how fragile did I make this thing? How many variables? I'm a 3-variable guy. I don't like 4. I don't like 5, because once you go past 3 variables, each additional variable cuts your credibility in half. Every time is the way I see it. So 2 is my optimal, but you need 3. You need an entry, an exit, and a risk budget, right? But if once you go beyond that with filters and all this other stuff, you're asking for trouble. And it's hard to turn that off, because the engineer in us, the creative engineer in us, wants to improve things. We want to try and add value, but it's not real. It's a fantasy. So you have to have the discipline to say, nope, this is a robust, durable system. I'm going to either accept it or reject it on its own merits, but I'm not going to make the same mistake that so many other people do in this industry, is just figure out a way to dodge the crash of 87 or go flat, during the S&L crisis or whatnot. So there is an art, Simon, to that process of knowing when to leave well enough alone.
Really
so
well
good,
said.
Eric. You're getting right to the very pointy end, and I'm loving it. Yeah, exactly what you're saying. I couldn't agree with you more. Simplicity is essential. Listen, talking about diversification, we've talked about your global equity exposure, laddered fixed income, your managed futures exposure. Let's talk about system diversification. Do you deploy that much in your models?
That's a good question. I haven't gotten that one in a while. So it's important because my bias, that's the other thing, is really you should be honest with yourself about what your biases are. And I try to be with mine. I have something called a small cap bias. That's just the way I was born and the way I think. If something's scarce, it must be more valuable. So I've always gravitated towards smaller markets. I want to trade palladium and I want to trade South African yellow corn, because the big boys can't trade it, because I think there must be alpha there. There must be value. It's not true. It's kind of true sometimes. It's negative alpha other times, but it's micro cap stocks. The differences are explainable, right? So when you adjust for turnover and taxes and transaction costs and slippage, almost all of that goes away. There's still a little bit left over in a lot of cases, but almost all of it goes away. So it's not this big, chunky, meaty thing that you can go pursue that you first had in your mind. So understanding your biases is really important. I guess now I probably have a simplicity bias, but that was learned. I think that's wisdom, right? Whereas before it was more just instinct. I wanted to pursue this thing. Did I answer the question?
Adam. We're all getting older.
So we're asking about
system diversification
of systems.
Yes.
Yeah.
Okay, so I have a long-term bias as well. So I like long-term trend following because all the tests I've ever done come back and say, chill out, just let your winners ride. It works better. It does work better long-term, but boy, can it underperform for 3, 5, 7 years. Case in point, we use 3 systems here. We have a short-term trend following approach, a medium-term trend following approach, and then my personal favorite, a long-term trend following approach. We've been around 5 years. Which one of them do you think has done fantastically well and which one hasn't? It's the other way around. Short-term trend following approach has been lights out, and the long-term trend following approach has basically been a dog for the last 5 years. Is it a surprise? COVID and all the chaos and, the fast markets and whatnot. It's not a surprise, but I'm really glad that we diversified across all 3 because they really paid big dividends. And again, if you don't diversify across all 3, then you're taking uncompensated risk along the way. It's the same expectancy long-term, but the sequence risk is just a lot higher. And it's uncompensated. So if that's another thing, Simon, that's kind of an art, is being able to determine what is an uncompensated risk, hidden risk.
What do you mean
Rich
there?
keeps talking about.
Okay, right, yeah. The hidden risks, yeah.
So yes, we diversify across 3 models, and that has really helped us a lot.
So what's the sum total of your return streams, Eric? If we say, let's say 3 models, how diversified do you like to be across the futures universe?
Okay, so now you're breaking open the Rubik's Cube. There's kind of multiple dimensions. So short-term, medium-term, and long-term trend following, but we also have grains, metals, energies, soft commodities, currencies, so on and so forth. And then inside those, you can have cotton and cocoa and sugar and lean hogs, and they're all uncorrelated with each other. You can have natural gas, which is totally uncorrelated with the rest of the energy sector. You have London gas oil, which is only about half correlated. So there's multiple dimensions of diversification. And you want to utilize them as much as you can to a certain point. You don't want to go too far. But you're getting the free lunch is if you can find uncorrelated return streams and bring them together. And you don't do the crazy stuff where you're manipulating them to try to make them uncorrelated. If they're truly collecting different risk premia at different time from different market players, then what happens is the denominator, which is either drawdown or volatility or whatever you want to put in there, goes down, and the returns can actually go up over time. And there's different levels of diversification, most of which no one ever gets around to even trying to pursue. And so we would stop it there, right? So we've got equities, and then we've got the managed futures program. Inside the equities, we've got European stocks, Asian stocks, and U.S. stocks. In the T-bills, we've got a laddered T-bill portfolio from 2 months to 12 months. And then in the managed futures strategy, we have short-term, medium-term, and long-term trend following. And then we've got the 6 or 7 different sectors. And then inside of the sector, we've got the most liquid markets in each one. So those are all the dimensions that I have control over. If I'm missing an available diversification that you're aware of, let me know, because I'd love to put it in there.
But you might enjoy going back to the chat we had with Jerry Parker and Moritz Siebert on the show, all 4 of us together, where we were debating how many markets is enough. And the theme, obviously, with Jerry and Moritz was there's never enough, I guess you could summarize. And obviously with Jerry trading, I think still around 300 individual equities, as well as his, what is it, Rich? Maybe 300 futures contracts.
I think he's 50% in equities. He had about 300 markets, so 50% in equities, and I suppose a balance in commodities and
something like that, right?
Fixed income, that sort of stuff.
But you're not necessarily chasing that, Eric, to just constantly be adding markets each year, so to speak.
Yeah, well, Jerry and I have been arguing about that since probably 2008. We agree 98% of things. But I kind of lost interest in, again, that was my small cap bias. I'll share with you another observation is the whole trend following on stocks. It's great, right? It's a viable strategy in my opinion. But you can take it to the sector level and get almost very, very similar results. And which was surprising to me. That was actually a big blow to my ego because I did so much work to demonstrate that trend following on individual stocks was the way to go. And then to disprove the people that I thought were going to criticize me, I decided to run basically the same strategy on sectors, expecting it to be horrible, and it came back looking great. I'm like, okay. So I was honest with people about it, and I said, well, you could do either or. But then I started asking myself, well, why? Why would it work on that? And it just, now this may be an uncompensated risk you're taking, but my hypothesis was that the alpha component or the trends is basically just kind of rolls through the different sectors. Sometimes it's the transports doing well, sometimes it's the utilities, sometimes it's the durables or whatnot, and it shows up in the individual stocks. So my bias still says, don't mess around with the sectors if you don't have to. Go get those individual stocks if you want them. But the empirical data came back and said, well, for as long as we have data, trend following on the sectors, pretty effective.
Our last show was with Gary Antonacci, and he just did a 100-year study on 48 sectors. And, of course, with all due disclaimers for pulling together 100 years of sector data from Farmer and French, nonetheless, it was a very powerful,
I did the same thing.
Experiment.
I have murdered their website, Farmer and French, and extracted everything and built databases and tested all kinds of stuff at various different slippage levels and delayed entries and exits. And that place is a gold mine if you want, equity data, and largely came to the same conclusion. Now all these things kind of converge on the same thing. They capture these medium and long-term thematic trends that kind of roll through the economy. But yeah, there's definitely something there. Now, after you pay the transaction costs, the fees, the taxes, all that other stuff, what's left over? Is it worth it? I think so. But it's how efficient are you at running a business and getting these things executed in a reasonable time frame with reasonable slippage. There's some work involved there.
Eric, now that you've mentioned, the technical experiment, pulling data out, backtesting, and so on, our audience are going to always be particularly interested in the tech stack that you use. Can you talk to us a little bit maybe about, let's start, say, with, is Standpoint fully automated, or do you manually execute trades? Oh, well, let me ask that first.
So it's a fully automated process for producing everything that needs to be produced. And then there's a firewall where it comes to a set of humans. So after I get off of, it's 5:00 p.m. in Arizona. After I get off this call, I will go out there and there will be a set of computers that have stopped and they're asking me to essentially intervene. So, and we have 2 other people that look at the process too. And a human being has to go through the checklist and make sure that the software is doing what it was designed to do. And then if everything checks out and you get through that, it's kind of like a pilot's checklist. then you hit go and it gets released and it gets sent off to the various brokers. Could it be fully automated? Yes, but every now and then the data providers will push through an erroneous price, or a contract specification changed, or a corporate action like a big dividend got missed. And when you've done this for as long as I have, you can just snip those out right away. You're like, why are we getting a signal in that thing? Like you drill down and we have red flags that pop up and say, this one looks suspicious. That only happens about, I would say, less than twice a year. In fact, you can go 2, 3, 4 years without any issue, but still somebody has to take responsibility for that. In our business, at least in the United States, we are running a mutual fund. If something goes wrong, you can't say it's the computer's fault. No, the liability's got to stop with a human, and that human's me. So I make sure there's a firewall there, and I check everything before it goes out.
So saved your bacon with that nickel debacle with the LME, didn't it?
We made a lot of money in nickel. We were on the right side of that move. And then when it happened and they locked down the market and wouldn't let anyone trade it, we had to do pricing. We had to make some decisions about how to price it because it wasn't trading anymore, but it was trading in Singapore. So we could have used representative pricing, hypothetical pricing to show even more profits, but we chose not to do that because, well, then you're going to give it back when it goes back down, right? So yeah, nickel was an interesting experience. I've since essentially delisted nickel out of our universe. I don't want the headache. It's a small market, and it's just not worth it. If it's not a functioning market and it's not truly building, or if it's not facilitating trade between hedgers and speculators in an accretive manner, then it's no longer a risk transfer market by my definition. And a trend follower.
Can we focus on that a bit? Because this is very interesting, because you've got a theory behind trends, the theory of hedging and speculation, one providing liquidity to the other. I've often heard you talking about this, and I think it's fascinating. Can you explain that to our viewers?
Yeah, I can. And I can just tie it right back to what I was saying. I believe that the profit that trend followers collect let's just focus on one economy, the United States economy, and let's just focus on the Chicago Mercantile Exchange. Futures are a zero-sum game. So if I make $10,000 being long copper, somebody else had to lose $10,000 because they're short the contract. The contract's always between two parties, and it's anonymous. So there's simply no way for me to be up 10 grand unless somebody else is down 10 grand because somebody else has to be on the other side of that contract. So a lot of people don't like that because they say, well, it's a zero-sum game. That's not what I'm looking for. I'm looking for something that lifts all boats, right? So they think that equities are that thing. And then they think it's kind of like a casino or a pawn shop where, you can't, like, for you to make a 12% annualized return, somebody else has to lose 12%. Like they're going to go broke over time. And then who do you trade against, right? They don't understand how the ecosystem works. I do, because I grew up in Kansas and I was neighbors with people that were hedgers, that actually worked these big agricultural companies. I went to school with them and I saw how they operate, and they do lose money.
Cap.
Yeah, exactly. Or Cargill, or a lot of these companies, right? They do lose money, and they're better off for losing money on their hedges because the hedges are negatively correlated with the risks on the balance sheet in their big company, right? So if they were making money on their futures positions, it means generally speaking, it means they're losing money in their core company, and then they really are going to go out of business. So a lot of times, a lot of people don't realize this, but it's truly amazing. If you talk to the managerial accountants and the CFOs at some of these companies, not just in the Midwest, but all over the U.S., their bonds, their financing rate that they need for their own debt, the yield goes way down if they hedge throughout the business. And the more money they lose on the hedge, it pays for itself in lower financing rate because they've got lower bankruptcy risk. So you think they're losing a lot of money on their hedge, fighting the trends. And they might be losing, 4% on the hedge book. But they're making double that at the company level by having lower finance rates and lower bankruptcy risk, which allows them to do projects that they otherwise wouldn't need to give more room to, like lower IRR product, or you use more leverage in certain projects. So it's kind of like we were talking about the trading system had multiple dimensions of diversification. Well, if you look at these corporate entities or like farming syndicates or whatnot, for them to lose the tons of money on their hedge actually makes them economically more powerful at the business level.
Right.
And people
so
just don't
this
realize
creates the edge. This surplus, effectively, we're talking about here, creates the opportunity for speculators like us.
Well, so I'm making a specific claim because Jerry Parker will take me to task on this, but the specific claim I'm making is that, yes, it is a zero-sum game. It's actually a negative-sum game because for me to make 10 grand, someone else had to lose more than 10 grand because the brokers needed to charge their commissions and the NFA and the clearing fees and all that other stuff. So it's a negative-sum game. But I'm saying that they're economically better off for having lost that money to me. And that actually increases GDP and overall economic health. If I was not willing to provide that liquidity to them, then they wouldn't be able to have lower financing rates and all this other stuff. So what I'm saying is that over time, if speculators, trend followers, managed futures, whatever you want to call it, are compounding at 8, 10, 12% a year, they're not really extracting money out of the system and then pocketing it. They're putting it right back in through taking risk and new stuff in their own funds and whatnot. But the hedgers are actually, they love it. It's just more liquidity for them to hedge off the risks they don't want to take. So what I'm saying is that trend followers, the source of their returns is hedgers, because hedgers are the only ones that have the pockets deep enough to pay them, right? They're talking about a lot of money here. It's not going to be small speculators. It's not going to be small traders. They're a tiny fraction of the market. The futures markets are 50% speculators, 50% hedgers, 45% speculators, and 5% retail. It's not the retail guys paying everyone else's yachts.
Very interesting, Eric.
Yeah.
Very interesting. Yeah.
Great to be able to answer that question.
Yeah, that's the symbiotic relationship. And at the risk of, because what people think I'm saying is that if you just find some hedger and take the opposite side of the trade, you're going to make a lot of money. No, I'm thinking from an accounting perspective. Over time, if I look and say, all right, I made $100 million in profits last year, who was the person that parted with that money? You can map that back to hedgers for the most part, in my opinion. That's my hypothesis. But markets are anonymous, so you can't prove it. And I love it. I love that you can't prove it, so you can never actually make this scientific, because if you could, a lot more people would be flooding into the space doing it.
It's free lunch of diversification that's infiltrating the hedging market, I think, what you're talking about there. So, yes, they are taking the opposite position. And yes, without that benefit that diversification brings to them, the hedgers, in smoothing out their return profiles from hedging their opportunities, maybe that's where it's all coming from. The diversification benefits on both sides of the equation. Don't know, but it's very interesting.
Yeah, they've got a different compounded return that they're trying to lift up. It's at the corporate level. Sometimes, like, for example, you guys have car insurance, I'm sure, if you drive cars, and you don't want that to be a profit center. You don't want to make money on your car insurance. You want to lose money on your car insurance, because if you made money, it means you were in a crash. Same thing with these guys. They don't want to make money on their hedge, because if that happens, it means that the opposite of what they wanted for their business actually happened. So they're happy to lose that money, because the one time that they needed it, if they weren't there, well, then that just sets them back. You could lose 6 quarters of earnings all in 1 quarter.
Yeah.
And then no one's going to lend you money anymore. And the financing rate on your bonds are going to go sky high, and you have to lay people off. Your reputation's going to get hurt. Your creditors and your vendors are going to start to be wary of you. So
that's
they
a
get
sequencing risk on both sides we're talking about. Everyone's trying to make this compound annual growth rate, this geometric return, and this is the consequence of it. Yeah.
Eric, can I just finish off a couple of those technical questions that I started then? So we talked about the automation level. For the average advanced futures trader who's doing back tests, what's a common data provider choice for them, if I may ask it that way? Like, are there any good options out there for data, historic data?
Yeah, I think the oldest and easiest for someone who's just getting in is CSI out of Florida. They do a great job. They've been around for, 40 years now, just consistently delivering clean, timely futures data for a pretty low price. We use them because we've used them forever. I've got my own account I've had for 15 years. And then the corporation has an account. Bloomberg, I like Bloomberg's data. We had Reuters for a while, but those are very expensive. Beyond CSI and Bloomberg, it's been a long time since I looked at this from the perspective of an individual trader. So I'm not sure Norgate over in Australia, I think, has data.
Yep. No, we use Norgate and are very fond of them. So absolutely jump on our website if you want to have a look at that.
Okay. Yeah. And then as far as software goes, it's been a while since I looked at futures trading software. We decided to bring everything in-house and not rely on vendors. And the reason for that is, in my experience, these firms sometimes get bought out and they change the terms on you. And I answer to a board of directors at the mutual fund level and then at the corporate level too, of which Tom Basso is the chairman. I got to protect the business. And that means not creating dependencies upon vendors that can just, go out of business or get bought out. So for some things, it just makes a lot more sense to bring it in-house.
So does that include your backtesting software?
Yes. I thought it was going to be too much. If you asked me this 10 years ago, I would have said, no, it's too much of a tall order to build your own simulator. But I partnered with the right people. And it just, if you don't need all the bells and whistles, like the charting and you don't need the problem with these vendors is they're trying to please so many people, right? So if you've got just one task and that's to build a durable, short to medium to long-term trend following system on futures markets, and you don't need all these crazy bells and whistles, it's order of magnitude easier to build that. So I just partnered with the right people and said, we're going to build it ourselves. And now we know how to troubleshoot it, debug it. We know how to use it. We can trust the results. We don't have to worry about the owner of this thing changing the terms on us, raising the price, or dying, or getting in a car crash, or going out of business, or whatever. So, because that's a threat to our business. So we brought that part in-house. I know not everyone can do that. It's quite an undertaking for an individual, unless you're a really good software engineer. But we made the commitment to spend the money and get that done before we launched the firm.
I might just do a quick shout out and say that, if you want to know about the software that we use, for example, we actually just did a podcast where we chatted with Marsden Parker, who has RealTest, which is an off-the-shelf software, and also Jason Strimple from PyQuant, who builds Python and teaches people how to build engines or build backtesting applications and the like in Python. And RealTest in particular is also very, straight to the point, no bells and whistles. What you can do in Python now is quite powerful. So again, we've actually got we're still running a $150 discount, I think, on Jason's Python courses. So for all of that, including Norgate data and so on, jump on the algorithmicadvantage.com and have a look at what we've got going there. And that supports the podcast as well.
Yeah, I'll take a look. I do get the feeling that things have advanced because I haven't paid attention in about 10 years to like the kind of solutions you're talking about. I think you had Lawrence on your podcast, I believe, and Tom Basso, and I think they've got their own software.
That's right.
Offering too.
I think you're right, Eric. I think a lot of the off-the-shelf software focus on things we actually don't need, and in fact, it overfits things or encourages curve fitting, and then you've got the task of extracting out all of the overfit components. It's sort of like a reverse engineering project. So if you never have to sort of get involved in that process in the first place, it's far superior. And I think you can do simplistic models that don't sort of incorporate all of those unnecessary bells and whistles that complicate things. So, yeah.
Get rid of the entertainment component and just go after the substance.
Yeah, well, the industry is pretty hell bent on the charting and the indicators and the fancy charts. So that's a tough one. All right, Eric. Look, that's been brilliant. I don't have a whole lot more. Rich, do you?
We've hammered Eric enough, I think, and thank you very much, Eric. It's been great.
Yeah, my pleasure. This is a really fun conversation.
Excellent, Eric. I mean, look, I was tempted. I'm going to jam it in the back end. Take us out, if you could, with whatever you can tell us about the nature of your trend following strategy, specifically in terms of, say, They're fairly simple. You've told us there's only you like to have a couple of parameters, short, medium, long term. So you're fairly diversified. You're not trying to chase 1,000 markets, but you are trying to spread the net fairly wide. You've chosen to roughly on a risk parity basis, I think, build your portfolio with buy and hold equities, large, almost 50%, say, buy and hold equities component in there. In the futures, are they fairly standard and simple models, or do you think you've got some particular edge that you're bringing to it? Are you trading standard kind of breakouts and Keltner channels and Bollinger Bands or whatever? Are there some other things that you think you've pioneered maybe that give you a particular edge?
I think the only pioneering thing we've done is to just get rid of all uncompensated complexity and go straight all the way back to the beginning and just try to do the blocking and tackling correctly. So it's just simple channel breakouts, 6-month highs, 9-month highs, 12-month highs. Mm-hmm. Same with the lows. And then make sure your stop losses are they're not particularly close. I don't like 2-3 ATR stop losses is too close. So they all work, chandelier exits, standard deviation exits. You can even do like percent retracements, just like, 1/3 of the 1 year range or whatever, as long as they're consistent. They kind of they follow the market, but they don't get too close. Channel breakouts, stop losses that are far enough away to be reliable and durable. Then you have to diversify across sectors and then within sectors. And then you have to have a risk budget, right? And for us, that's 10%. That's basically like if every single position in our program goes against us all the way to the stop losses all at the same time. So we have a 0% win rate and a 100% failure rate, and we liquidate and we get those prices at the stop loss. How much will we lose? For us, that value is 10%.
That's fantastic. See, a lot of people would confuse that and think it's your volatility target, but it's not. That's your heat. That's your total risk exposure. Yes.
Right. Approximately, that's what I expect to lose if everything goes wrong. Now, what happens after that? That's a different story. We could put new trades on a week later and lose money on those. But at this point, I hit my circuit breaker. I stopped the pain. We've reset, and we're not going to take any new trades unless there's new trends. They can be long, short, or whatever, and then we're going to take the appropriate amount of risk then. But that circuit breaker is what keeps you from letting a small, painful experience turn into a fatal, terminal experience.
One last question, Eric. I'm not sure if you mentioned this already, but you've got the buy and hold equities component with the ETF. You've got the trend following overlaid on top. Is the trend following as it would be even if you didn't have the equities component, or is it lighter on the equities component because you've got the equities beta down below?
It's a great question. No one's ever asked me that. It is lighter. I don't know that someone could say, is it lighter because you've already got the equities, or is it simply calibrated to be in harmony with the equities?
Wow.
Because if you're liquidity weighting your positions in a managed futures program, the S&P is going to be enormous, right? And you have to liquidity weight if you want to have capacity. If you want to have 12 billion in capacity, you have to treat crude oil as if it's 20 times as important as heating oil because it's 20 times bigger. And gold's a lot bigger than, say, palladium or platinum. Otherwise, you run into capacity issues at like $700 million. We've already passed that, right? So we do liquidity weight our exposures. So it's kind of like market cap weighting on the equity side. We open interest weight on the future side. But for equities, we do have cap. Have you ever looked at some of the MSCI world indexes for foreign countries like Brazil or Chile? Because one company has like 90% of the market cap of the whole country, they put a cap on that one crazy company and say you can only be 25% of the index, and then everyone else is properly weighted. But the one guy we can't just put 90% in one company. I'm doing that as well with the S&P 500 because it's so enormous. Beyond that, everything is just straight up liquidity weighted. Because of that, there is our exposure to equity futures would be higher if I didn't do that. But I think doing that's the smart thing to do. Part of when you put all your own money in this fund, it makes it, in my opinion, a lot easier to just do the right thing, right? To make the decisions, that doesn't make any sense. Or yes, I'm willing to take that risk. The trade-offs, if you believe in your own personal utility function, if you're naturally a compounder yourself, you really should have your own money in your own fund. There's trade-offs, right? There's some people would say you shouldn't do that. You should diversify your personal risk. But again, that's why I created an all-weather vehicle, right? If I had some Bitcoin thing, I would not be telling you I'm putting all my money in my own fund. That would be crazy. So, but no, to answer your question, yes, the equity futures is diluted to a certain degree. Part of it is inspired by the fact that we don't want to double up on our equity, buy and hold equity exposure. The other part is inspired by that capping the S&P 500 futures just simply because it's such a big market. And I don't want it to dominate the future strategy either. So I solved two problems with one action.
And that does remind me of my forgotten question, which is, do you end up volatility adjusting your positions?
Not individually. So we have that 10% risk budget I talked about. That's enforced according to the open interest in the markets, right? So we will take a certain amount of risk in each market according to its own open interest, but the denominator of the fraction is the 10% targeted risk, right? So like, for example, if you looked at our portfolio right now and you were able to get the stop loss for every position and do the algebra and sum it all up at the bottom, it was, I think I last looked, it was like 9.83%, something like that. And you'd say, well, this is kind of lumpy. A lot of it's in natural gas, a lot of it's in XYZ market. And it's, why are certain markets bigger than others? Well, because those markets are bigger than the other ones, but it still sums up to approximately that 10% risk budget over time. What I don't do is say, oh, we're long crude oil, and it's gone up a lot, so we're going to peel back from that one just because it's up a lot.
Thank goodness, Eric.
Yeah. Because what ends up happening is you end up underweighting the ones that really drive the performance. So here's a fun exercise. If you have access to some managers who are willing to give you their performance attribution, people that have had 15, 20, 25-year track records, and ask them this question. Go back and look at 3 5-year rolling windows and tell me what your profit distribution was and how lumpy it was. And what they'll tell you is that 80% of the returns came from 20% of the markets over any rolling 3 to 5 year window. And the markets that the returns came from, if you went back in time mentally and looked at those, you would have said, there's no way this can go any higher. There's no way it can go any lower. We were short crude oil right before COVID. And people told me I was crazy. Why are you shorting crude oil? It's already all the way down to $65 a barrel. How much lower can it go? Well, it went to negative 35, right? And if we didn't have all the short exposure on and gas oil and heating oil and natural gas and all the different energy markets, well, we would have been hurt, because everything else in the portfolio was going down. So it's lumpy, and you don't want to steal from winners to subsidize losers in this game. It just doesn't work.
Yeah. Great. All right, we can all be friends then.
Our value system is close enough.
Yeah. Indeed. All right, Eric,
Awesome.
Thank you so much, mate. We really appreciate it. That was fantastic, super informative. Yeah, thanks once again, and thanks for hanging around for so long.
Yep. My pleasure, guys.
Thanks, Eric.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.